Hello everyone. This next clip provides you with some insights into transaction capital risk services. TCRS's diversified funding model enables it to perform well in both a positive and a negative environment. Firstly, TCRS is diversified across three business activities: collection services, transactional services, and value-added services. Within its largest business activity, collection services, TCRS has a diversified revenue model, allowing TCRS to be defensive. Agency collections thrive in a positive consumer credit environment, whilst a negative consumer credit environment is conducive for the acquisition of Npl portfolios. TCRS is further diversified across geography, sectors, clients, mandates, and even individual consumer accounts. This positions TCRS defensively. And in a very difficult year, TCRS was able to grow revenue from collection services by 14%, driven by SA collections revenue increasing by 19% and Australian collection revenue increasing by 26%. That's all organic growth, an excellent result given the difficult consumer environment heightened by COVID-19. The SA macro and socio-economic environment is challenging, placing pressure on consumers who are further adversely impacted by COVID-19. In South Africa, there are 37 million adults, of which 27 million are credit active, and 10 million of these, or about 40%, are classified as non-performing. We see elevated levels of unemployment at about 30.8%, which is at the highest in 12 years. Experts estimate that about 2.2 million jobs were lost in the second quarter of 2020. We also see things like no work, no pay policies and household debt to income remaining high at 72.8%. Monthly household income has deteriorated when you compare it to 3 years ago, if you look at the bottom right-hand side of the slide. The sector where TCRS focuses, being unsecured loans, reflect significant levels of arrears at 77%, which is an opportunity for us in TCRS. Our own index, the Transaction Capital Consumer Credit Rehabilitation Index, shows that the consumer's propensity to repay debt is deteriorating, specifically over the last 3 quarters, Q3, Q2, and Q1 of 2020, with weak economic conditions and being exacerbated further by COVID-19. TCRS's business model has gained in relevance in this difficult post-COVID-19 environment. We see increased unemployment, we see increased indebtedness, impairing the consumer's ability to repay their debt. Our clients, being the banks and the retailers and the insurers, etc., have much larger NPL portfolios to manage than ever before. Their balance sheets and operations are under pressure, and they are all trying to shift from fixed cost into variable cost infrastructures. This increases their appetite to either sell NPL portfolios or to enter into outsourcing arrangements with people like us. TCRS is strongly positioned to accelerate the acquisition of NPL portfolios and win agency collection mandates, specifically as regards our successful establishment of our work-from-home capabilities, where we now have more than 1,300 call center agents working from home at increased efficiency and increased productivity. In Australia, the consumer is employed but highly leveraged, with short-term unemployment and emerging risk at 6.9%. We see persistently high levels of household debt to disposable income at about 190%. This economy entered its first recession in 30 years due to reduced economic activity exacerbated by COVID-19. A further emerging risk is the government support programs, which are now all coming to an end. Market dynamics for participants in this sector include reduced access to funding, increased regulatory compliance, lower sales of NPL portfolios, and a shift towards fee-for-service contracts. Despite this environment, a small position in this large and fragmented market provides a meaningful opportunity for TCRS to grow both its agency and NPL acquisition businesses, where we currently have a small market share. I will now focus on a few strategic growth initiatives to create value. Firstly, as market dynamics post-COVID-19 become clearer, the acquisition of NPL portfolios in South Africa and Australia to be collected as a principal provide opportunities to accelerate capital deployment for attractive risk-adjusted returns. TCRS's funding requirements for the acquisition of NPL portfolios, both in South Africa and Australia into 2020, are already secured. Next, the strategy to acquire non-performing consumer-based loan portfolios in Europe remains valid and will be pursued. The European collection market is many times larger than the South African market, and again, a small position in this market will provide a meaningful opportunity to TCRS. TCRS will maintain a cautious and selective approach, and the portfolio will be diversified by asset originator, collection platform, and geographical region. The intention in Europe is to co-invest in partnership with specialist credit managers. There are 4 very important points that I want to make on this slide. Firstly, investment into NPL portfolios this year was reduced due to COVID-19. In South Africa, we invested 653 million rand into NPL portfolios. That's down from the 1.1 billion invested during 2019. And in Australia, we invested 80 million rand into NPL portfolios, and that's down from the 122 million rand that we invested in 2019. Despite this, revenue from principal collections increased by 23%, which is an unbelievable result. And revenue from the collection of NPL portfolios in Australia was at about 100 million rand. Next, collections on our NPL portfolios performed at an average of about 85%, well above our expectation communicated at our half-year results. However, future collections are anticipated to recover more slowly and over a longer period of time to only about 96%, with expected remaining collections expected to be about 4% lower over the medium term. This gave rise to the adjustment to the carrying value of purchase book debts being up by 270% to 588 million rand from 159 million rand in the 2019 year. The important point is that this adjustment ensures that future yields on our existing book remain aligned with those achieved in the past and protects our balance sheet. Finally, it's important to note that TCRS has the ability to adjust its pricing methodology to the prevailing environment to ensure that when we buy future NPL portfolios, the price is adequately adjusted such that we achieve targeted returns and targeted collection multiples. TCRS's financial performance before the adjustment to the carrying value of our purchase book debts was robust. Core pre-provision profit from continuing operations increased by 12%. Total income was up 16%, and non-interest revenue was up 18%, all supported by organic growth revenue from collection services up 14%, SA collections revenue up 9%, and Australian collection revenue up 26%. Our business in Australia performed in line with our original budget, regardless of COVID-19, which is an unbelievable result. Core operating costs increased by 13%, driven by the implementation of our highly effective work-from-home capabilities, the proactive restructure of our staff complement and infrastructure, and going forward we anticipate that staff will continue to work partly on a work-from-home basis, but also then rotate into an on-site basis during the month. This all results in improved productivity levels, yielding about 90 million rands of cost saving without compromising revenue growth into 2021. The way we have structured our business is that we can now generate more revenue but at the same time by incurring less cost. Our balance sheet is also robust and free cash flow generation was strong. Thank you everyone. Until I see you again, stay safe, stay healthy and stay productive.